Hello everybody and welcome. This is Tushar Chande. The S&P dropped sharply in the week ending August 2024, and in retrospect my parabolic accelerating long stop or PALS exit gave us a perfect exit a couple of weeks ago. So let's dive in and see how it happened. A gentle reminder, past performance is not necessarily indicative of future results. After a generally dovish Fed meeting, the market prepped for the unemployment report on Friday, and the Bureau of Labor Statistics reported that unemployment rose to 4.3%, and the job creation was below expectations at 114,000. So that really triggered the market on Friday. The SAM rule that we have discussed before rose above zero point 0.5 and ended at 0.53. And in the past, this has correlated with rising unemployment and recessions, and that's why the market recoiled on Friday. This chart has daily data for the U10 ETF, which tracks the US Treasury 10-year note. And the indicator here is the FAMA, or fully automatic moving average bands, and observe the sharp rally over the last 3 days as the market became increasingly worried about the state of the economy. Now we're up against long-term resistance, and you'd have to have a sustained breakout in this area to really confirm that the market is strongly worried about what's happening in the economy. This slide summarizes the performance of several ETFs sorted by 1 week performance. The U10 US Treasury Note ETF is on top with a 3% gain, and semiconductors at the bottom with a approximately 10% decline. The widely diversified, or the small stock index based on the Russell 2000, also had a terrible week, even though many people expected this to rally strongly. Technology was the lower end, and SPY was somewhere in the middle. This is my complicated prop indicator on the trend strength, and you see we're down to minus 300, which suggests that there's a downtrend underway. And in general, you see that when we had a strong uptrend, we had values at plus 300, and during the downtrend, we had values at minus 300. I was hoping that the market would continue here at the plus 300 level, but of course, the sell-off has belied my expectations. This is daily data of the S&P 500 index. We're using my automatic regression channel indicator set to 73 days to pick off this particular low. And the inner bands are plus minus 1 standard deviation. The outer bands are plus or minus 2.5 standard deviations. This week we were slowly getting support at the lower band, and then on Friday we fell through the lower band. So this is a bit of a concern. The question is, are we going to continue lower or find support? So let's find out. This is the daily data for the S&P 500 index with my blast indicator, which is the buy low with accelerating stop indicator. It has all default values. So for example, here we have an entry point with an exit there, an entry point with an exit there. But now here we have a sense of volatility because we went above the trigger line, would have entered, say, somewhere over here, and the market reversed sharply and gapped below our trailing stop. So this is a risk with the strategy, and at the same time gives you a sense for the volatility of the market. This is the daily data on the S&P 500 with the Chande Kroll exit. This is a trend following approach. Again, you'd have entered somewhere here and then gone all the way to the top and then got stopped out a little bit below 5,500. So again, that gives you a sense for the ability to absorb some volatility and of course get an exit that was relatively timely, but that's all a mechanical system can do. This is daily data for the S&P 500 index with the PALS indicator, the parabolic accelerating long stop. We're using the 10-day high as the entry point, the 20-day low as the starting level, and 1 as a nominal speed. So this would be our entry area, and then the trailing stop gave us an exit just say 2 days after the absolute high of the move, which as it turns out was a pretty darn good exit for a mechanical system. So to calibrate the pullback for this year, we'll use last summer's sell-off. Using the October low and the summer high, we get a pullback into the Fibonacci support area of 38.2% to 50%. So let's see how that works for this year. So using the ideas from the previous chart, we use the November low and the recent high, and the pullback would be in the 50-70 area for a double-digit drop of about, say, 10.5%. So that's consistent with a 10% or a double-digit drop that happens once every year. And again, we have 5 waves down, so potentially we have some zigzag action down to this area. So changing gears a bit, this is seasonality for Nvidia going back 26 years. August tends to be a positive month, being positive 73% of the time. So August will be a good test of seasonality for Nvidia, and also it would be consistent with the zigzag 5-wave decline in the market. So we might expect to see a bounce in Nvidia and the broad market soon. This is daily data for Nvidia with the FAMA indicator. We have support near the bottom of the bands, and we are at the bottom of the band here, and we have also retraced 62% of this rally. So consistent with the seasonality pattern, we might get a bounce here, perhaps to the top of the band up to the 130 level. I hope you like and subscribe, and the tools I've used are on TrendSpider.com, and here's a link to get them. Thank you very much.